A heavy sell-off hit the US equity indices on Tuesday. The S&P 500 fell the most since after the announcement of poor jobs data last month. Nasdaq 100 fell 3% and Nvidia tumbled almost 10% yesterday. Now all eyes are on the critical US jobs data, which is due, starting from today to the end of the week, and which has the potential to throw a floor under the recent sell-off or make things worse. So welcome. This is Swissquote's Daily Market Talk. Well, September really began on an ugly note, to say the least. The US equities tumbled at their first trading day of this month after the latest ISM data from the US showed a fifth month of contraction in the US manufacturing activity, and unfortunately at an accelerated pace. So the latter actually revived the recession worries ahead of this week's critical jobs data from the US and sent the S&P 500 more than 2% down. So this was its worst sell-off since August 5th, when a weak jobs data from the US had boosted the recession worries in the US. Remember, the expectation of a 50 basis point cut from the Fed, and also resulted in an almost 10% sell-off of the S&P 500. Now yesterday, the technology stocks led losses. Nasdaq 100 index dived more than 3% as Nvidia tumbled nearly 10% as part of the broader macroeconomic worries and suspected AI fatigue, and another 2.42% in the after-hours trading on news that the DOJ sent subpoenas to the company because, it suspects that Nvidia violated antitrust laws, made it harder to switch to other chip makers for its clients, and penalized companies that actually didn't use its AI chips exclusively. So in Asia, TSM tumbled 5% and South Korea's Hynix fell more than 8% in the early hours of today. Now, we know that the antitrust allegations are, simply part of the daily life of all big technology companies. They obviously come and they go without doing too much harm to these big technology companies' growth potentials, as many of them are, natural monopolies and others naturally benefit from their dominant market positions. But I believe that, the Nvidia news come at a time when Nvidia is much vulnerable, guys. Because look, remember, it was just a week ago that we saw Nvidia releasing blowout results. They actually exceeded their own sales forecast by $2 billion for the fifth consecutive quarter. They gave a strong, and more importantly, a stronger than expected forecast for the current quarter of $32.5 billion of sales. They announced a strong stock buyback program, and they addressed issues regarding the delay of the Blackwell chip, saying that, there is nothing to be much worried about there. But yet, the stock price, fell after the results, as investors simply focus on potential problems like, what if the big technology companies like Meta and Google cut their AI spending? But hey, the big AI spenders like Meta and Google, they insisted that they will continue to spend big and overspend if necessary to make their AI investments worth it. So what I'm trying to say here is that, except the DOJ news, obviously, every piece of recent news from Nvidia could have been interpreted in a positive way, but they have not been. So that, to me, is obviously a sign of fatigue. And it's in the middle of this bad mood that Broadcom is preparing to announce, good results this week, thanks to a rebound in networking equipment sales in the second quarter, like Cisco, and also conversion from perpetual licenses to subscription model for VMware, which was a company that Broadcom acquired last year. But unfortunately, good quarterly results may not lead to a positive market reaction, because the stock already tanked more than 6% at yesterday's trading session. And no one can guarantee you that good-looking results from Broadcom would reverse its sell-off. Why? Simply because, the broad macroeconomic, the broad market environment is simply not supportive of risk appetite, of risk-taking right now. And we know that the technology and especially chip stocks that have greatly benefited from the AI rally since the start of last year are trading at very high valuations that are no longer appetizing for investors, no matter how well these companies do, because the good results are already baked in these high market prices. Meanwhile, on the macroeconomic front, the slowing US growth and soft economic data boost the recession worries and the rate cut expectations. And the rate cut expectations favor a sector rotation from highly valued big technology companies toward the non-technology pockets of the market. But the expectation of a jumbo rate cut is bad for all stocks, regardless of their technology exposure. But in all cases, technology stocks are under pressure. But the others are as well, because Nasdaq certainly recorded the biggest loss, but the Dow Jones also fell 1.5% yesterday from an all-time high level, and the Russell 2000 index dropped 3% as Nasdaq did. Now, in the bond space, the US 2-year yield fell to 3.85% yesterday as expectations of a jumbo rate cut from the Fed rose on yesterday's soft economic data. The probability of a 50 basis point cut from the Fed in September rose above 40%. The 10-year yield retreated to 3.82%, and the US 30-year yield fell to 4.10%. Now, all eyes are on the US jobs data, which has actually the potential to either make things worse or throw a floor under the recent risk sell-off. So today, the job openings data from the US is expected to print fewer job openings. Yet on Thursday and on Friday this week, the ADP report and the official jobs data are expected to show a rebound in hiring and wages in August. So it feels like good news will be good news when the US will be revealing its latest jobs data later this week, meaning that we could eventually see the market react positively to potentially strong data and negatively to potentially soft data. And that's because the Fed expectations are soft enough right now to support risk appetite, but too soft expectations obviously bring the worries of recession along with them, and or a too late easing from the Federal Reserve. Both are no good news for growth prospects and risk taking. Now, speaking of poor prospects, crude oil tumbled more than 5% at yesterday's trading session and is testing the $70 per barrel level to the downside for US crude this morning. Rising recession worries that support the expectation of waning global demand, and also prospects of fewer production restrictions from OPEC later in October, combined with the falling tensions in Libya that would allow 500,000 barrels to return to the market, are actually waiting on oil prices this morning. Now, I believe that sufficiently strong jobs data from the US between now and Friday could eventually bring the dip buyers to the market. Yet if the jobs data from the US looks ugly, we could then see US crude settle below the $70 per barrel level for a while. In the FX markets, the falling US yields didn't pull the US dollar index lower at yesterday's trading session, as the greenback benefited from risk-off inflows. As such, the euro-dollar extended losses to 1.1026 level as cable tipped a toe below the 131 level. Both are better bid this morning. Now, a soft set of economic data from the US could bring the US dollar bears back to the market. But if the market shifts to the panic mode, then the US dollar sell-off could remain limited, as the US dollar would amass all these safe haven flows. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.